topic is commodity market outlook and challenges, recent challenges in especially in developed and emerging market economies. Then we will try to explain what's happening throughout the 2025, and we will take a look at the deep analysis of the commodity market. By the way, when we speak about, for those who are not familiar with the topics, when we speak about the commodity is like the metals, energy, lots of things which can buy and sold in the financial market. It can be even metals like gold, palladium, aluminum. It can be even the agricultural products like cacao, soybean, anything, or it can be an energy product like natural gas or petrol. We can call all these products generally as commodity. So if we differentiate the financial market, we have the stock exchange. As you know, the companies in the financial market like Apple, Microsoft, or Nvidia, these are the stock exchange. Or if we differentiate the financial market into different side, this first one, the stock market, is risky asset. If we focus on the riskless asset, these are the fixed income. Fixed income meaning government bonds and treasury bills, which may pay the regular coupon payment at the end of the maturity. You can get the money as well. These are the fixed income securities. And we also have the commodity market, as I said, like metals, agriculture, or energy products. Lots of different things. Now, let's first focus on the energy prices and energy market outlook, what's happening there in the financial perspective. On the left-hand side, you will see in this chart, you will see the time frame here from 1990s till now. Approximately, we are covering 30 years. And here in the y-axis, we will have the Brent crude oil United States dollar price per barrel. Okay. And here, as you see in the screen, normally till the 2000, it is around $20 or $30. Then after the dot-com crisis, the prices suddenly hike up till $140 per barrel. And here, as you see, there's a sharp contraction in the energy prices from 140 to less than 30. This is the 2008 global financial crisis all over the world. And when you face a recession, financial market crisis, or real market crisis, the first effect coming through the commodity and the stock exchange market. So here there's a sharp contraction, and with it, when the United States and other advanced market economies started their bailout program, and they give lots of incentives to the financial markets, then there's a recovery process in energy prices from $30 till 120. Here, the stability periods, the prices are stable around 100. And then here, as you see, this is the euro. Portugal, Greece, Ireland, Spain, those type of, not the core markets like the Germany, France, and other things, but here there's a sharp decline again. This is the euro crisis, euro debt crisis. Then here, as you see, we converged in the spot market around zero per barrel in the COVID-19 crisis. When you enter any type of spot buy or sell, even you can buy one barrel of the Brent crude oil, even $0. This is tragicomic, but this is real. You can buy it at zero, even zero. And then with again another bailout program coming through the advanced market economies, and with the retaliation and climbing of the conflict then converted into war, the Russian-Ukraine crisis, one of the biggest economies who is the supplier of the natural gas and the petroleum, invade a country in the Europe, the Ukraine, then this crisis rise up the energy prices approximately again $140. Then we are balancing and finding a new price equilibrium around 70 or $80 per barrel. Here, 30 June is approximately $68, and today 67. One barrel United States Brent oil is around approximately 67. What this picture gives us about the risk and risk appetite, if you don't have a chance to look at all financial market outlook or all financial market risk indicators, and if you only may see the energy prices, even from this chart, you may understand in which direction the risk appetite is going throughout the world. If the energy prices going down, the risk appetite is shrinking, meaning that nobody wants to buy or get additional risk in financial market or stock exchange, because the energy market, commodity market, and stock market is cyclical, meaning that they have going through the same direction. So if you see the energy prices shrinking here, you will see almost all stock exchange and company prices in the United States, S&P 500 or Nasdaq, will go down as well. Here, if the energy price is rising up, this is not demand. This is supply side shock. For instance, from here to zero to here, normally from $20 to $50, the market is buying stock exchange and the energy market at the same time. But then the energy prices is positively differentiated from the stock market because of the adverse supply shock coming from the Ukraine and Russia crisis. For instance, the energy price is increasing here, but stock market is not. Stock is sell. So if you try to understand what's happening in financial market and what's happening in real market, you should also get familiar with the topics of where this price effect is coming from. Is it a demand side shock or is it a supply side shock? If it is a demand side shock, the energy prices and the stock prices is cyclical, positively correlated. But if it is a supply side shock, adverse supply side shock, then they are going in the different direction, negatively correlated. Here, as you see, the prices of the energy is going up, but the stock price is going down. And on the right-hand side, another best well-known energy market commodity, the natural gas. Here, this is the euro per megawatt or United States dollar. On the left-hand side with orange color, you will see the euro prices. And on the right-hand side with the black chart, you will see the United States dollar prices. Here, we should familiar with the topics of, in any case, the United States and euro prices of the natural gas is really rising up during the Russia-Ukraine crisis. Yes, the energy prices, even Brent oil going up, but the natural gas prices is a little bit positively differentiated because the Russia is the almost the largest economy who is supplying the natural gas to the Europe. When the Russia closed all pipelines passing through the Bulgaria, Romania, and the Poland, then the prices from 50 euro rise up to 350 euro. It is up almost 7 times higher. When the conflict is going down, the prices adjust and converge to their equilibrium level around the 50 euro. Right now, we are in the stability period. You should keep in mind like this. And here, we should take a closer look at what is happening in the oil supply and oil market and energy market in commodity, a special commodity. The energy is the best well-known commodity, and the oil is best well-known energy. Here, the contribution of the energy oil supply to the global oil production. As you see here, we will see the different countries, and here we will see the million of barrel per day. For instance, the United States producing each day approximately 13 million barrel oil, or the Russia 10 million, Saudi Arabia 10, Iran, one of the best well-known economy, and you may also right now understand that why the oil prices go up when the Iran and Israel start another conflict in Middle East. Even Iran has a small production, but it is one of the biggest among the economies. If we take a look at first six, they are producing approximately 4.3 million per day. And when there is a start of the conflict between Israel and Iran, the oil prices go up $78, approximately 20% increase in oil prices. And Iraq, another country, then the OPEC Organization of Petroleum Exporting Countries. These are excluding Arabia, Iran, and Iraq, like the Venezuela, and lots of countries here. This is an organization like the NATO or like the NAFTA. This is another organization. This organization is just consists of the countries who is exporting the oil products, and the rest of the world per million barrel 30. So if we sum up these just six countries, as you see, United States, Russia, Saudi Arabia, Iran, Iraq, and OPEC countries, their summation is higher than the 100 countries in the world. So these countries, these six countries or organization, is really, really important for the oil production and prices. If there is a crisis, if there is a war, if there is an escalation, if there is an undemocratic challenges in these countries, the oil prices will negatively or positively affect at the same day. For instance, if there's a problem in Turkey or Egypt, or let's say if there's a problem in Japan, it will not affect the oil prices because these countries are really, really small to affect the oil production. But the sixth one is have a power to affect the oil prices throughout the world. And now, on the right-hand side, this is the US crude oil inventories and rig count. Why these oil inventories are important for us? Because at the end of any production and supply side shock, we will basically understand that in any case, if there's an inventory increase, this means that the production or consumption is decreasing, right? For instance, if you have an inventory in your stock, this will directly reflect that if you buy the oil production from the center, and if you don't melt or decrease your inventories, this means that nobody buy your oil, nobody consume. So your inventories is increasing. So even just take a look at, by taking a look at the oil inventories in the market, you may even understand that in which direction oil production and consumption is going. So please take a look at here. Inventories here, from here to here, million per barrel, okay? And this is active rigs. After the United States, when the Russia close all pipelines and only the United States sell their products to the Europe to compensate the loss coming from the Russia, all inventories is going down because everybody buys the United States natural gas and petroleum products. during the Russia and Ukraine conflict. Okay, you may easily understand the charts and their reflection and their risk appetite perception by just take a look at this assumption. And another, this is the metal side. The first two these are the energy. Energy one is natural gas, oil, Brent, crude. All this one is energy market. And now we are in the metal market. This is the iron ore in the metal market. And this is the well-known metal commodity. And on the left-hand side, this is the iron ore prices and China's steel production. I will briefly explain why this China is important for iron ore prices and their steel production. Everybody here knows that to produce the steel, you need two things: coal, I mean fire, ore, and iron, right? If you have enough fire and iron, then you can produce the steel. So to understand the iron ore prices, if the China steel production increasing, the iron ore prices will go up. Because to produce the steel more, China will buy additional iron ore from different markets. And the coal as well, the fire, the heating to the iron ore. And from 2015 till now, approximately we have here 10 years. From here, this is United States dollar. The price is in United States dollar per metric ton, the iron ore, ferrochrome. Okay. Here, as you see, we start with the $50. Then the prices with the Russia-Ukraine prices again goes up approximately 225, meaning quadruple, 4 times higher when we compared 5 years ago. Then with the stability and rebalancing of the Russia-Ukraine prices, then the prices is balancing around $100 per metric ton in the iron ore market. And here we should also take a look at the China steel production. Here the year, as you see, this is the months, and the purple one is 2025, orange is 2024, and the black one is 2023. Normally, as you see in summer months, there is a seasonality in the production, meaning that every summer in June, July, and August, the steel production is increasing because of the seasonality. But here in 2025, there is not much enough rise when we compare 2025 with 2024 or with 2023. It should be, the purple one should be around here, but it is less. Why? Because China is now in a recessionary period. They are trying to create inflation. Compared to the rest of the world, they are in other direction of the monetary policy. For instance, the United States, Euro area, United Kingdom, these are decreasing the interest rate and decreasing the inflation. But in China, not. They are trying to increase the inflation because there is a recessionary period, deflationary period in China. So if there's a deflation, there is no enough production. And this 2025 is not enough high like 2024 or 2023. You will understand the China steel production in this perspective. And the gold, the best well-known products all over the world. Everybody, I think, even man and human, put some saving in gold under their pillow or bank account or anywhere else, because gold is like the money. You can convert gold everywhere directly in cash. Gold is everything. Gold is real money, ladies and gentlemen. The fiat money, the banknotes you hold at your hand, it is just a paper. The central banks put a signature on it and saying that, please give everything from the supermarket for these gentlemen and ladies, because as the central bank, I will pay it. The signature on your banknotes giving this permission. Otherwise, those are just paper made from the cotton. Okay? It is just a paper. But gold is not. Gold is a precious metal. It is real money. It is not a fiat money. Okay, it is not a banknote. It is real in everywhere. It does not affect from the inflation. It does not affect from any other type of things. It is the real money. And on the left-hand side, you will see the gold prices and real interest rate. This is the gold prices, and this is United States dollar per ounce of the gold prices. And here, the inverted interest rate, real rates. Real rates mean nominal rates minus inflation expectation. When we are converting something from nominal to real, we are adjusting and transforming those nominal things from the price effect. So this real rates is excluding the price anemone. And on the left-hand side, as you see, as the real rates goes up, please look at this one. As the real rates goes up, this is inverted, okay? This is inverted. So from here to here, this means that the real rate is increasing, okay? From here to here, real rate increasing. From here, -1 to positive 2.5. There is an increase in real rates and the gold prices as well. Meaning that if the real rate increasing, it means that inflation decreasing or nominal rate increasing. There is only two scenarios in this case. If the real rate increasing, either we have an increase in nominal rates or we have a decrease in inflation expectation. In any case, the gold price is rising up. So if you want to keep up your mind how the real interest rate correlated with the gold prices, the real interest rate is positively correlated with the gold prices. If the real rate is going up, the gold price is going up as well. And on the right-hand side, we have gold demand by different sectors because gold is a precious metal. Lots of central banks hold gold at their reserves, right? Like the reserve currency, like the United States dollar, Great British pound, euro, Japanese yen. These are reserve currency. And lots of emerging market economy central bank hold these reserve currency at their reserves, at their central bank. But also they hold gold in their reserves. Like China, like Russia, they are holding in an increasing amount of gold reserves in their central bank account. But other than the central banks and real markets, we have gold demand by different sectors. As you see, this dark blue is central banks. Please look at these bars. This dark blue is the central bank's demand for the gold. And the light blue is investment. Lots of people investing for gold. As I said, it is like a money. You can put under the pillow, even in your account at bank. This is an alternative investment for you. And the technology, because gold is a real technological product, precious and better than the silver or the copper. It is really, really good transformative effect. And the jewelry, especially in Eastern economies like Turkey, India, or African economies, lots of women use the gold as jewelry. So the most of the demand, 50% is coming from the jewelry. The small, approximately 5% is coming from technology. 10% is coming from the investment from the real household, and approximately 10 and 15% coming from the central bank as a reserve perspective. And here, while we are trying to look at the risk perception, we should also understand the commodity market and reserve currency, because these commodity market can directly reflect the risk perception and their risk appetite throughout the global market economies. Why we should take a look at this understanding? Because as you see here, currency movement from 2025 year to date versus United States dollar, meaning that how the advanced market and emerging market economies currency move against the United States dollar. Turkey, this is my country, the only depreciating currency because of the higher inflation in the economy. And almost all economies, emerging market, India, China, Thailand, Malaysia, South Korea, these are approximately get appreciation against the United States dollar around 5%. But like Switzerland or Euro area, the appreciation against the United States are approximately 12%. Why? Because the United States economy is saying that we will decrease the interest rate and we will need a less strong dollar all around the world. The Trump administration declared to the rest of the world that we don't want a strong dollar. So we will decrease interest rate, we will put lots of tariff and trade barriers throughout the world because we wanna give current account surplus and we will need a weak dollar, not a strong dollar. After this declaration, Switzerland franc or euro get a huge appreciation against the United States dollar. Except as you see, the Turkey, almost all economies gaining strength around the United States dollar. And now we should take a look at the United States dollar index and interest rate differential because the dollar drivers is coming from two sides. The first side is current account balance and trade channel, and second one is the interest rate differential between 10-year treasury yield between the economies. And on the left-hand side, you will see the dollar index. This light gray area is the recession period, dot-com crisis, global financial crisis, and COVID-19 crisis. These are the crisis period. And as you see, dollar index is directly correlated with the interest rate differential. United States 10-year treasury yield less minus developed market 10-year treasury bond exactly have similar direction with the dollar index, meaning that if the United States interest rate decreasing, the dollar losing strength. But if the United States interest rate differential is going up, then the dollar gaining strength against the developed market economies. And the volatility. Why this volatility perception is really, really important for us? Because it will give the basic message for us around what will happening in commodity market. This is VIX. VIX is Chicago Board Option Rate. This is Option Volatilities Index. In the recession, please take a look at here again, recession, dot-com crisis, global financial crisis, and COVID-19 crisis. If there is a recession, if there is a crisis in the economy, volatility and the fear index is going up. Fear is increasing, as you see here. Normally, the threshold value for the VIX index is 30. If VIX index is higher than 30, ladies and gentlemen, this means that there is a really, really decrease in risk appetite and there is an increase in fear around the world. You should keep in mind like this. Then I should give another explanation. This is the MOVE index, another alternative for the Chicago Board Option Rate. This is exactly similar, but there's a differentiation in the calculation of the VIX and MOVE index. And now we should take a look at this alternative asset correlation, return and yield throughout this time. As you see on the screen, on the left-hand side, you will see the 10-year annualized return. And here, 10-year correlation for the 60-40 portfolio, meaning that 60% in stock exchange and 40% in fixed income securities. And this black one is the real estate, the orange one is the infrastructure, the purple one is the private market, and the light blue is the hedge fund. Normally, as you see, 60-40 portfolio and 10-year, please look at the 2014 till the end of the 2024. And here, please look at this one. Real estate market is less sensitive to the 40-60 portfolio. This means that if you want to make a basket of the risky and riskless asset, the least sensitive one is the real estate and transport market. But venture capital and the private market equities is highly sensitive, and their volatility and return is increasing. By the way, if there's an increasing in your return, it should be have a high volatility. Volatility means return, ladies and gentlemen. If your volatility is really small, your return is small as well. And here we have portfolio return and stock bond contribution. This is the black one is equity contribution. The purple one is the bond contribution and total return. Please look at here. In the dot-com crisis, there is a negative return. In the global financial crisis, another negative return. And here in COVID-19 crisis, we have another negative return with Russian crisis and COVID-19 crisis. But at the end of the picture, at the end of the movie, we will see that annual return on a basket, 60% of the stock and 40% of the bond, meaning I'm giving additional weight to the risky asset with 60%, and I don't want to take all the risk, and then from my 40%, I will take riskless asset from bond market. Then at the end of the session, as you see, around 5%, I will have an annualized return. And stock bond correlation, I should give this picture as well to you. The correlation between stock and sovereign bond market, stock and bond market almost have same direction, because if there's a risk appetite increasing, everybody who loves the stocks, buying the stocks, but institutional investor buying the bond. In any case, there's an increase in demand of stock and bond market. So here, as you see, there's a crash in 6-month correlation with bond and stock market, because 6-month correlation now in a negative terms, but 1-year correlation is around 0, meaning that if you take a longer perspective and long-term maturity for your stock and bond correlation, at the end of the class, you will see the positive correlation. But if you take a look at for the short term, you can see some negative correlation between stock and bond. And this is the power of compounding. The last slide from my side. This will give the picture from you that if you are enough patient, and if you put just $5,000 with 5% per year growth, as you see here, starting age at 25 or starting at 35, if you put at your 25 just $5,000 and it is growing 5% each year, your 5,000 after 30 years will be 400,000, ladies and gentlemen. This is the power of compounding. This is the fruit and gift from God if you have enough patience in stock, bond, or equity market. And if you put just 5,000 in stock market, if you reinvest your dividend to the market again, now you are not waiting too much. For instance, if you put in 1980s 5,000, in 40 years, your 5,000 will be around $300,000. So while making a long-term perspective investment, please don't forget the power of compounding in the financial market.